Welcome to Your Powerful Legacy TV. My name is 𝗱𝗠𝗃, and I'm joined today by Kristina 𝗱𝗶𝗀𝗃 and Rob 𝗱𝗶𝗃 of Powerful Legacy Insurance and Financial Services. To our viewers at home, we have a very important topic today. It's sometimes looked at like the elephant in the room, but taxes. We're going to jump in and talk about taxes, specifically taxes in retirement. So often we're being told that income is going to go down in retirement, so therefore, hand in hand, taxes should go down as well. That's not always the case, and we should always plan for higher taxes down the road. Kristina, how are you today?
Fantastic to be here with you always.
So excited to be with you.
Yes.
You look beautiful in your blue.
Thank
Absolutely.
you. Likewise. We look like sunshine today.
We do. And the blue and the yellow just kind of coordinates together. I love that.
We all
Rob,
picked this out, didn't we? I'm feeling great today. How are you? I mean, it's wonderful to be here for everybody, and we're excited to have another show of important information to deliver.
I am so excited about today's show because obviously it's sometimes a very difficult subject to talk about taxes. It makes everyone like, oh, taxes, I don't want to talk about it. But obviously in retirement, so often people feel that their taxes are going to go down because their income potentially would be going down. So of course that should go hand in hand. But before we start unpacking that category, Rob, I want to ask you right out of that, what is the difference between tax preparation and tax planning, like what we do on April 15th versus the rest of the year?
Tax preparation, you're going to your CPA and you're figuring out how to pay the government money. Tax planning is to properly figure out how taxes are going to go in your future, not what's in your immediate front sight. So it's very important to be able to have that and plan for it.
Okay, perfect. Kristina, also when someone is doing tax preparation, are they looking in the rearview mirror, looking back, but not looking forward?
Right, right. You hit the nail on the head. Planning is going to be proactive, and preparation is just going backward and preparing what you've already done. You know, I think about that like preparing the table when you've cooked dinner and you're just getting ready to serve that. That's
right?
how that feels, yes. But tax planning, we're anticipating what the taxation should be and making sure that that's part of your entire financial plan. And a lot of times people don't want to talk about that in their plan. You're right. They think taxes are going to go down because their income's going down.
Yeah.
I'd like to know how many of you folks think that taxes are going down? Nobody. Okay, that's the way that's going to work, and that's okay. So if you have that as part of your full retirement plan, taxes are a huge piece of that puzzle because for most of us, we save money pre-taxed.
Interesting. So that is a very specific thing is what I'm trying to say, saving money pre-tax. So you're talking about what you're putting into your 401k if it's not a Roth, if you will.
Yes, you know, the 𝗍𝗠 2.0 Act made it to where you can now have Roth 401k, which is great. Just a lot of extra reasons to save is what I'm really looking at in that 𝗍𝗠 2.0. Look that up. And if you don't have it, by the way, just pick up the phone and call us and we'll send that over to you on email. It's very important. All these tax changes, that's exactly what it's about, taxes. And all of these amazing pieces that you can have in your puzzle. So let me mention one that I really like. This is just an absolute favorite, is going to be a Roth conversion. You can convert taxes that pre-tax money in your traditional IRA or from your 401k over to a Roth IRA. And remember, it's not like contribution. You're not limited annually. So we've got some opportunity out there to save a little bit more for the future. But then also we have to have that conversation about longevity. What if you do not have the health and it's not a possibility that you're going to have longevity? Should you convert all those taxes over for what? Well, now that the 𝗍𝗠 2.0 is out, you can't leave a stretch IRA to a non-spousal beneficiary without them having to pay those taxes within 10 years. All of these tax rules, we've got to keep up with this on a regular basis. I'm not a CPA. Our CPA does an incredible job giving us all of the advice, but tax planning should be part of your overall retirement plan.
Kristina, thank you. And Rob, how detrimental is it to someone if they're not factoring what future taxes could be and they're planning to retire? How does that look? Have you had someone in the office recently that you've helped with this?
Well, I associate that with people just sticking their head in the sand and saying, well, two things are promised, taxes and death, and we can't do anything about it. Well, you can. You can certainly make those adjustments. You're going to pay taxes. I mean, that's irrelevant. You can't get past that. But how much in taxes is certainly up to having that proper structure in place for the future and how much you're going to pay versus how maybe pull back how little you're going to pay on taxes. So we want to make sure that you're not leaving money on the table. It's very important to understand that taxes equal a lot of money, of your hard-earned money that you have worked very, very hard to pay for.
Thank you, Rob. And Kristina, most people have 3 different types of accounts. Let's talk a little bit about that, because how can that be affected by taxation? Some of the taxable accounts might be like money that you pay income tax every year on, of course. What about if you don't spend the money? You're paying taxes still, even if you don't spend the money?
So one of the things that you need to think about is, where is your money and what are you trying to do with it? So did you know that inside of a CD, a lot of us really love CDs because the rates are doing really well right now. It's a good, safe place to park the money. Yes, it is FDIC insured, but also you're going to get a 1099 on those taxes every single year on the earnings. That's not good. I mean, we want to defer those taxes as much as possible. What if you're inside of an annuity and it's deferring those taxes? Well, eventually that tax bill is going to come due. So what is that going to look like for you? Then what if you're inside of some other investments? You know, let's just say you're in some mutual funds. What do the taxes look like on that for you, and how is that going to be decumulated and dispersed? What about capital gains? Long-term and short-term capital gains, whether it's on your investments or your real estate, that's another piece of the puzzle. So talking about all of those different types of taxation, it flows into all the different types of investments that you have, and what kind of money was that before the investment actually took place? Was it pre-tax money, post-tax money, Roth money? What is that? Because they're all very different.
You certainly don't want to mix those funds.
No.
So
No,
we've
and
seen
that
that
happens.
as well. Yeah, so it does happen, but it's very important that you keep those funds separate.
Okay.
I'll give you an example. So CDs right now, we have a lady, she's a mother of a client, and she had $92,000. And she came to us and said, you know, hey, listen, I want to put this somewhere. And she said, I'm looking around. And she went to the bank to get the money, and the bank said, we can put that in a CD and we'll do better. So she listened to her banker, who she's been with for a long time. There's nothing wrong with that. But the banker recommended that she take an extra $8,000 out of her savings account and put it with that money so it would be a jumbo CD, which is a better CD. Well, they just mixed qualified and non-qualified money.
Wow.
So either she gets a big fat IRS bill or she's going to have to pay taxes again. Well, they were going to have the favor of the big fat IRS bill because they didn't even mark the CD as an IRA. And it was an IRA going in. So all of these mistakes, a lot of times bankers are not financial planners. And we do have a junior associate in our firm that's over in Louisville. And she came from a banking background. It's quite extravagant. She's told us so many horror stories of things that are like this. I mean, we see this all the time. So making sure you get that taxation right, you could be penalized dramatically if you don't.
Well, and it just factors in, again, we've talked about this in prior episodes, but having a second opinion before you make any major moves like that, because that could have been a very serious tax consequence.
Yes, and actually I went up there and had them back it out, give her the interest that she would have earned in the first place, separate the money, and show that it was separated and put it into an actual IRA. And it took a lot of work. And I know that for some of you out there, that may not seem like a lot of money, you know, $92,000. That was a lot of money to that lady.
Of course.
And I still think $5 is a lot of money. I mean, that's almost a pizza these days. So
of course.
depending
Starbucks.
if it's on sale. Yes, that's some Starbucks too. Yes, we want to be really careful and make sure that you do not make those mistakes. And when we're talking about tax mistakes, probably the #1 mistake that I see is going to be people not even planning for taxes at all.
Yeah, and that can be very detrimental, very scary. Well, Rob, I know that you and Kristina have been generous enough to set aside some specific time blocks for new clients that are coming in for the very first time. Perhaps they have questions about their financial future, their taxes. Let's talk a little bit about what that looks like before we take our very first commercial break.
Certainly. Folks, taxes, if they're on your mind, and they should be a very important part of what you're discussing right now, give us a call. What you see on the TV is what you get from us. We're the same people. We want to help. We want to be there for you. We're offering this to you at no charge at all. Come in, talk to us. Call us at 877-893-5099 and claim your complimentary review. We want to sit down with you and discuss taxes in your retirement.
Rob, thank you so much. Kristina, thank you so much. To our viewers at home, that number to call is 877-893-5099. We know that you just heard the story about Kristina going to the bank for her client and making sure that that outcome was in favor. That is just the type of people that you're dealing with. Rob and Kristina, they do take the time. They care about their clients so deeply and so personally. They want to know what's best for you. They're going to make it right. That number to call, 877-893-5099. Don't miss the opportunity to take advantage of this complimentary consultation. You truly have nothing to lose and everything to gain by sitting with Rob and Kristina. If you have your smartphone handy, go ahead, grab it. You can click on that QR code at the bottom corner of your screen. That will take you right to Powerful Legacy Insurance and Financial Services landing page. You can schedule your time accordingly. We're going to take a very short commercial break here on Your Powerful Legacy TV, but don't go anywhere. We're talking about taxes and retirement and how you should be doing some tax planning. Stay tuned.
One of the many questions that we get is, when do I do a Roth conversion?
Let's just talk about what a Roth conversion is. I love Roth, don't you?
Yes, absolutely.
The tax-free distributions and the tax-free growth make it just absolutely amazing. Did you know that while you're still working, if you have in-service withdrawal available, just call your HR or we can call up your custodian and ask them. Did you know we can start moving that money over to Roth? Almost everyone that I talk to says taxes are not going down. They're going to be going up. So we might as well start saving with tax-free money for the future. Let's talk about the difference between a Roth contribution and a conversion. A contribution is when you're putting the money in. You know we're limited to that annually. There are all sorts of rules because it's the government. So let's talk about conversion. That's something that is completely individual to you. Most of the time we want to talk about it in the month of December, because we want to see what your annual earnings are and make sure that we don't go into another tax bracket.
Kristina, what is the purpose of a Roth conversion?
To make sure that we're not paying taxes more than what we have to. It really is that simple. You pay taxes on everything multiple times. So imagine this for just a moment. You probably do not have Roth 401k available at your work, or if you do, you're just not contributing toward it. Did you know that you can actually, while you're working, take an in-service withdrawal and do a Roth conversion with that money, so then that money would continue to grow tax-free for the future? This is not for everybody, and we need to make sure that we take the right amount at the right time. Give us a call. That's what we love to do. Let's make sure that your taxation is going to be favorable for the future with a Roth.
Welcome back to Your Powerful Legacy TV. My name is 𝗱𝗫 𝗱𝗏, and I'm joined today by Kristina 𝗱𝗫 and Rob 𝗱𝗫 of Powerful Legacy Insurance and Financial Services. We're talking all about taxes today, where you are currently on the tax horizon and what that future could look like and how you should be planning accordingly. Kristina, I should ask you, obviously, I love this segment that we just played with you and Rob talking about the Roth conversion, because I know you love Roth conversions, and it ties kind of into where we are right now today. So where are we in this tax environment? Where are we looking, and why are you passionate about Roths? Two questions there.
Yes. So first off, I do love Roth. Roth and the tax code 7702 are the only two ways to save tax-free for your retirement future. Let's talk about how you can look at what your taxes will be and what are some of the ways that we could actually change that. We have a calculator on our website. It's called the Retirement Tax Bill Calculator. I want to be crystal clear. When you pull up this calculator, that information is not farmed. It's not going to anybody else. I want you to have an opportunity just for information just for you. So it'll take a couple of clicks here. Once you click on that QR code there at the bottom of the screen, it'll take you to yourpowerfullegacy.com. Retirement Tax Bill Calculator is in the upper right-hand corner. It'll then ask you, what is the amount that is in your 401ks and IRAs? This is all of the pre-tax. Don't put any Roth in there or any money that has already been taxed, like out of your checking or savings. And then what is the age of yourself or your oldest spouse if you're married? And then what is your average tax rate? If you don't know, just click that default button right there at 25%, put in your name and your email address. It's going to give you a quick briefing of what the retirement taxes should be and what they could be. And then give it about 5 minutes. The software takes less than 5 minutes. It's going to kick over your personalized report. Folks, these reports are extensive. They're 3 to 5 pages on just your personal taxes in retirement. It may come to your junk, so watch out. It'll actually be coming from your retirement tax bill calculator. So that's a really big deal. Make sure that you're taking advantage of that and find out what's the possibility of what your taxes could be and what should they be.
Are people often surprised to learn once they go onto your website and they go through that process what their taxes actually look like?
Yes, I mean, if we were to say what could cause a heart attack, taxes are probably one of them.
Yes, I'm sure.
It makes me think about my oldest son, Tyler, getting ready to be a father. And the first time he got his first paycheck, he was 15, working at a landscape company for the summer. And I was getting ready to take him to the bank, and I took him by. He picked up the paycheck, and he was opening the envelope as we were driving down the road, and he goes, "What the heck?" And I'm like, "What's the matter?" You know, I thought something was wrong. He goes, "My check is nothing like what I thought it would be." I said, "Oh, welcome to FICA."
Yes. Absolutely. It's amazing when you look at it, how it whittles down when you factor in taxes. Absolutely.
Yes. Could you imagine how much money we would have if we didn't have to pay all that in taxes? Holy cow.
I know, I know. Well, Rob, you and Kristina talk a lot about taxes being on sale right now. What does that mean for where we are in tax history?
Well, 2025, they're going to get readjusted.
Okay.
So, folks, it's coming. We don't know what it's going to be at this point. There's rumors here and there of what could happen to it. It's going to go up because spending's going up and our debt's going up. So it's something you need to pay attention to. I believe that it's going to be a significant impact on us. So how can you hedge against that? Well, that's what we need to sit down and discuss and talk about. How is your future strategy working for you, and how is that going to play into effect if we take a 5-6% increase on just regular taxes? So it's very important that we talk about this and we come up with a solution for you.
Rob, thank you so much. Kristina, a lot of people have their money tied up, if you will, in tax-deferred accounts like traditional IRAs, 401ks. Let's talk a little bit about how we have to plan properly for taxes when we're talking about those folks.
Oh, my heart, when you think about that, what if you're close to retirement but not quite there? So let's say that you're about 7 to 10 years away, and we know there are going to be some changes in 2025. Don't panic. This is not a zombie apocalypse. It's just taxes, or you can panic because it is taxes, one of the two, whatever makes you feel good. But just think about this for a moment. I want to do some simple math with you. 2%, just a 2% increase on your taxes. 2% over 10 years is 20%, right? That's easy math. Your dollar today is only worth 80 cents in 10 years. That is a huge impact. I think about how inflation is such an impact. Inflation is the hidden tax, and tax is the hidden inflation. So we need to get a handle on that. If you don't control the taxes will control you, and you'll pay too much.
So basically, it's kind of like a ticking time bomb. If you're not planning for taxes, Rob, if you have all of your money tied into a 401k, you have a silent partner that's in that 401k. So the amount that you think you have is not necessarily the true amount.
Right. It's going to be a deflated amount, but what if we went to a consumption tax as a company? Not to get all political on people, but everybody pays in 18 to 20% across the board. We get rid of most of the IRS. We get rid of a lot of different things. How does that play out for that? Well, I think more people contribute at that point. That's not happening right now. It's not going to happen anytime in the future. The spending is continuing to get out. I'm not saying out of control, but we're spending more than we're bringing in.
Yeah.
And that's not good in any business. And what Kristina, I like to use this analogy. Kristina says, if your house and your sewer backs up and it keeps going up to the second level, what do? Do you build another floor in your house, or you pump the crap out? Well, you've got to pump the crap out. So we've got to be mindful of this, and we've got to be very strategic about it.
So it really comes down to just proper tax planning. Well, Kristina, you and Rob have a very special offer, because I know that you've set aside specific times for new clients. Let's talk about what that is before we open the phones.
Yes, folks, we're always trying to offer information. So first off, if you're looking for information on taxes, what could your tax bill be? Again, that retirement tax bill calculator, we will have that up again in the show. But at this moment, we'd like to discuss exactly what our offer is, an offer for a complimentary plan. This will include taxes. Taxes should be part of your overall plan. This should be a holistic approach. This plan is a full retirement plan. You'll know exactly what to expect from Social Security, taxes on Social Security. I have so many people that don't even know Social Security is taxed. I'll tell you about that. But we want to make sure that you know exactly what that outlook is going to be. What is your income going to be? What do we need to do to adjust your income, or maybe even adjust your lifestyle to accommodate those changes in taxes? So please feel free. Give us a call, 877-893-5099. we want to give this to you. It's not like it's not important because it's no charge and it's also no obligation, but folks, we know that you need this information, so we'd love to give it to you. Also, when you come in, we'd love to give you a complimentary copy of the book, The Retirement Train. I know you're going to love this. We do have a couple of other books available. We have the Holistic Retirement, we have Taxes in Retirement, some other educational tools. We do have some tax pieces, the 𝗍𝗫 2.0, so a lot of different ways to just give you information, make sure that you're on track with your taxes.
Kristina, thank you so much. And Rob, thank you so much. To our viewers at home, that number to call is 877-893-5099. You don't want to miss this opportunity to call in and to book that complimentary consultation. Even though it is complimentary, it is invaluable advice. You need to listen to where you're going with your retirement years. Do you have a tax plan in place? Are you nervous about what taxes could look like? What Rob and Kristina are offering you is the complimentary consultation. Come into the office, sit down, let them get to know you, your goals, your dreams, and your plans for retirement. Again, the number, 877-893-5099. If you don't have your pen, grab your smartphone, click on that QR code at the bottom corner of your screen. That will take you right to Powerful Legacy Insurance and Financial Services landing page. We're going to take a very short commercial break. We're talking all about taxes, Roth conversions, and so much more. Stay tuned. We'll be right back momentarily.
So Kristina, one of the things that we hear all the time is, when should I start drawing from our retirement accounts?
You know, that's a loaded question. We get a lot of those, don't we?
We do.
Folks, I don't think that there is any one answer for when is the best time to withdraw the money from your retirement account. It depends on several things. First off, how old are you? If you're under 59 and a half years old, did you know that on those pre-tax retirement accounts, you could end up paying a 10% penalty? Watch out. Have you started your Social Security? Did you know there's taxes on Social Security? All those items? When's the best time to even start your Social Security? That's important. Then when it comes time to actually withdrawing from your retirement funds, should you withdraw from that first? Or perhaps let your Social Security grow a little bit more? Folks, what if you had the ultimate plan? What if you knew exactly when to draw down so you knew you wouldn't run out of money? That's what we'd love to talk to you about. Come in and see us, Powerful Legacy Insurance and Financial Services. We'd love to let you know, are you on track?
Welcome back to Your Powerful Legacy TV. My name is Cynthia DeFazio, joined today by Kristina Ping-Kepperling and Rob Kepperling of Powerful Legacy Insurance and Financial Services. We're talking all about tax planning, future taxes, and what you should be doing today to make sure that you're going to be okay in the future. Kristina, I want to ask you some of the negative side effects that can be triggered, if you will. We're talking all about your 401ks and all of that good stuff, your TSPs, what have you. Let's talk about some negative side effects that can be triggered when we're talking about taxes.
Well, I want to talk about when people make a few mistakes inside of taxes. So first off, everyone assumes that your taxes are going to go down. That may not be necessarily true, so you would need to talk to someone about that. One of the things that a lot of folks do not like to admit to, or they may not even know, is that Social Security is taxable. So the timing of Social Security could be detrimental to your overall retirement, because for a lot of folks, Social Security is 36 to 40% of their retirement income. And I'd love to give an example. This is a little terrible to even say, but I have a gentleman that came into the firm. He had called into the TV show and he said, I just want to talk about Social Security timing. My best friend, my fraternity brother, he's my financial advisor. I don't want to talk to you about anything finances, just my Social Security. I said, well, no problem. So I got a little bit of information and I said, I have a couple more questions. So are you still working? He's like, well, yes, I'm an attorney and I make $200,000 a year. I said, well, congratulations. And you're 62 today. And you want to retire at 65, is that correct? Yes. I said, okay, and why would you collect at 62? What was that reason? He said, well, my buddy told me to do it because Social Security probably won't be here. All right, it's not like we haven't heard this one before, but let me break this down. I went back to my personal office, ran the Social Security report, which we do for everyone who comes in who has not yet filed for Social Security, because that is, again, a big piece of that puzzle. When I ran the report, he was correct. The cumulative amount during his lifetime with longevity, filing at 62 would be the best. but the excess earnings limit for 2023, $22,240, we're in trouble because he's well over that excess earnings limit. And I'm sorry, for 2024. And so making $200,000 a year, it would have just completely wiped out his Social Security.
Wow.
What's the point of filing if it's just going to wipe it out? And no, you're not going to get it back. So why would you file? What was that? He took the report back to his bestest buddy, and they're not friends anymore. And he's our client.
Yeah,
because it was that big of an impact. And what's worse is when he said to his friend, why didn't you tell me about this? And why didn't you research this for me? What else did you not tell me about, and what else didn't you research? And we went over his entire financial plan. He needed a lot of adjustments. Not saying anything bad about somebody else, but there were a lot of things that were not catered toward him. And come to find out, they did have several fraternity brothers together. They all had the exact same plan. This is not uncommon.
There's a lot of people out there that
That's
they just
scary.
don't discuss the other things out there because A, it's too expensive, or B, the person that's working with them may not make as much money on.
Or they may not know.
They may
That's
not know.
okay.
Or they
But
may
money
not
should
know.
be, the money they make should be irrelevant. Doing the right thing, making the right placements, discussing the right topics, that's what you should expect. I mean, that's what everybody deserves is total honesty about everything as far as your retirement and talking about it. Don't hide behind a fence. Don't not talk about something just because it may be inexpensive or expensive, whatever it may be. You need to talk about all of it, and you need to talk about it with your advisor.
Well, his buddy should have just
100%.
said, I don't know. That would have been
Yes.
the answer. Instead of telling him, oh, well, it's not going to be here, so file at 62. That's a huge mistake.
Yes.
I'm also seeing this mistake with taxes, Cynthia. A lot of advisors are saying, well, your income's going to go down. You're not going to spend as much in retirement. That's not true. I'm seeing a lot of plans that as we do the entire retirement roadmap, that their income ends up being almost double in about 20 years. The need ends up being double because inflation takes a toll, taxes take their toll. What about your medications?
Absolutely.
I mean, everybody's property values go up, so that goes up. Your utilities, your food, everything takes an increase, so your income needs to increase with that. It is serious that that is inclusive in your full plan.
And when you're in the go-go
Absolutely.
years, you're pulling out more. If it's qualified money, you're getting taxed on that. So it's just something that needs to be discussed.
Well, with only a minute and a half left of the show, Kristina, I want you to leave the advisors or the audience, if you will, with one final thought. It's different working with an advisor who specializes in the accumulation phase of life versus distribution. How can that impact someone's retirement overall if they're with a different type of advisor?
Yes, your professional is probably doing a really good job at the stage that they're at, but not all of us are a decumulation and wealth preservation specialist. That's what we like to do. We want to make sure and preserve your wealth through taxes, Social Security. Obviously, we want to make sure that you have all of the income that you're going to want and you're going to need to maintain that lifestyle. That full holistic plan is not something that everybody does. We do also have powerful partners. I want to make sure and give them the credit. Our Medicare specialist, property and casualty insurance, our CPAs, attorneys. It takes a whole crew put together to make sure that your retirement is truly powerful. Let's make sure yours is together today.
Kristina, thank you so much. Rob, thank you so much. To our viewers at home, most specifically, we'd like to thank you for spending time with us today on Your Powerful Legacy TV. That number to call is 877-893-5099. We know that you have a lot of questions for Rob and Kristina about how to plan your perfect retirement. They have the answers for you. Be safe, be happy, and be blessed. We look forward to seeing you back here 1 week from today. Take care now.